It's Jobs Week in America. Later today, we're going to get ADP's. Now I think they're just messing with it. We're going to get ADP's read on private payrolls. On Friday, we're going to get the government's employment report. In case you didn't know, living under a rock somewhere. Lindsey Piegza is chief economist at Stifel, covering the equity angle with Steve Parker, head of specialized strategies at JPMorgan Private Bank, which would. I don't want to have a bank that would have me as a client, but I definitely could not be represented by.
We'd love to have you, Joe.
Liar. Lindsey, we haven't talked to you in a while. You think the Fed is still on track to cut at some point this year?
I think right now, when we look at inflation, still very sticky. The economy is still relatively solid. The consumer, yes, losing momentum, but still out in the marketplace spending. That's going to be very difficult for the Fed to justify a rate reduction. I think they're on track for an eventual reduction, but eventually increasingly looks like a 2025 event to me.
Well, you said a lot there, though.
I did.
Because you said they're on track for an eventual cut. And there's a lot of people that say as long as Powell doesn't blink the slightest bit on a possible raise, that we'll be okay. So that's if the next move, if you can tell me the next move is a cut, that speaks fine. It might be 2030.
Well, Chairman Powell has been pretty clear that there's still an easing bias at the committee, that the next move is like he doesn't know what
the date is going to be.
But he's also set the bar pretty high for a rate hike. So we would have to see a meaningful reversal in inflation, meaning likely 6 consecutive months of inflation moving away from that 2% target before the committee would be willing to re-engage and not just delay eventual rate cuts.
Are you on the same page?
Yeah, I mean, our base case is that we get a cut in December. But again, it's one cut for the year, a couple at the start of next year. But I think what we do agree on is the fact that the next move is lower, and this is as good as it gets for cash.
Because that would be the non-consensus viewpoint and the big worry that whenever the market really sells off, I think it's because it's sinking it won't be the 70s, but they could make one mistake about a stop-start that we saw back then. They could have ended too soon. We might not be restrictive. We don't know for sure. There's no signs really in the economy. Maybe there are. Are there signs in the economy that it's starting to bite? We are restricted.
No signs in the market.
Well, I think we are seeing a loss of momentum. We have seen this cooling effect. The labor market is still tight, but less tight than it was. The consumer's still spending, but spending at a noticeably reduced pace. So we are starting to see that loss of momentum or that second derivative decline, but the overall rebalancing is falling well short of expectations, still justifying these relatively elevated
like
levels
a soft
of policy.
landing, not
a
any
soft-ish.
Sort of
We're not there yet, because remember, part of the soft landing is that eventual return to price stability, and we're still well above the 2% target, with really no confidence yet that we will return to that disinflationary trend.
NASDAQ, new highs, up 7%. Meme stocks back. Bitcoin's over 70,000. Where are you not seeing sort of excitement and liquidity? And I just don't see how they suddenly people are telling me that the risk of a slowdown is equal to the risk of renewed inflation, and I don't think it's even close.
So one, we think this is still a great environment for stocks. Fundamentals look good. Growth is slowing a little bit, but still at a good pace. Inflation is easing. We think that's a really good environment for companies who are growing earnings at a really strong pace. One of the things that we look at when it comes to bubbles or speculation and what you're asking about is how are profitable companies doing relative to unprofitable companies? And in some of the past bubbles, what you've seen is that unprofitable companies tend to outperform significantly. Over the last year, as we've seen a rally in the broader market, that hasn't been the case. Unprofitable companies are actually only up a little bit. So that's one of the signs that we're watching for concerns around a bubble, and we're not seeing it right now.
Okay. Friday. What's going to happen?
I think after a disappointing number last month, we were down to 175. I think we do inch slightly higher, around 185. So pretty much in line with what the market's expecting. Still, again, we talked about those solid labor market conditions, but a loss of momentum from where we were in 2022, 2023 on average. The unemployment rate still below that 4% threshold at 3.9. This is now the longest stretch below 4%. We have to go all the way back to the 1960s. So we are continuing to see this idea that labor demand is still outpacing labor supply, perpetuating the notion of wage pressures and adding further uncertainty to that longer-term outlook for inflation that the Fed is desperate to return to that 2% target.
Disappointing to whom? The 175. A lot of people liked it.
Well, I think
you got to define your terms, though.
I think it supports the notion that the economy is still growing.
We're looking for weaker numbers, though, aren't we?
We are looking for weaker numbers in terms of supporting the notion that we are at that sufficiently restrictive level. But I do think, as we've long argued, the Fed, with this hyper-focus on achieving the soft landing, stopped short of where we needed to be to ensure a return to price stability. Not just sit on the sidelines and hope for it, but ensure a return back to 2%.
Stephen, that's what I think. They got to move the goalposts. They're not getting to 2 anytime soon. They'll say, well, we can see it. Powell actually said that once. We're not going to cut rates now, but we're getting close.
I think the trend is the thing that's most important. And when it comes to this Friday, what we're focused on more than the headline number itself is what's happening with the wage data. Because at the end of the day, there's a lot of signs that inflation pressures are easing. The thing that could throw a wrench in that is if all of a sudden you see a reacceleration in the wage data, which I think would cause the Fed to give a little bit more pause on their direction of travel.
What's the estimate and what would concern you? 0.1% higher than the estimate?
You know, I think I'll defer to Lindsey.
What is the average hourly estimate?
Well, right now we've been averaging right around that 3% pace. And that's enough to, again, sustain the consumer. But when we look at wage pressures, even globally, we continue to see these surprises to the upside, which may throw a wrench not just in terms of the Fed's longer-term pathway, but the ECB and the BOE as well, which are on path.
The ECB is going to do it this month.
They are, but if we see any further surprise to the upside in terms of wage pressures, that could certainly slow their progression and grow that timeline between the expected reduction this week and the next rate reduction by the end of the year.
I just think watching the Fed might be what slows the ECB down. You're
that
not going to want to be
too.
that far ahead of the.
But remember, this global policy divergence, the expected divergence, is likely a reflection of differing economic conditions.
Yeah.
We've seen much slower growth overseas as opposed to here in the U.S., and that disinflationary trend has been much more robust overseas than it has here in the U.S. So, again, I do think that when we look at these different central banks around the world, there's justification for easing abroad that we're not seeing here at home.
So you are fine with one cut. You're happy. You think stocks are going up. Good environment. You don't need 5 or 6.
Well, we think
weaned yourself off of what not you particularly.
Yeah.
But as a Wall Street guy, it's not all about cuts for you.
Yeah, because we actually think that one cut is a scenario that reflects a strong fundamental growth environment more so than a reflection of potential weakness. We don't think that this economy necessarily needs that boost because there's enough natural positive tailwinds that are going on that are supportive of markets and of risk assets.
Are they natural positive tailwinds, or is it a lot of excess from the fiscal side of things?
No, I think you look, yes, fiscal has been a big tailwind. But if you look at the private sector, both corporates and individuals, they're in fantastic shape, both in terms of their balance sheets, in terms of income growth or earnings growth. These are really positive signs. Earnings are what are driving our expectations. We think over the course of the next year, you can get 8 to 10% out of the S&P on top of the rally that we've seen, and that's entirely because of the earnings growth outlook. We think the story is actually even better outside of the U.S.
Is that because these companies are able to raise prices and gouge, as we hear constantly, Lindsey? Because, middle and low-income consumers are not feeling income growth, and they're not feeling earnings growth.
Well, they are feeling real
more.
earnings growth. Inflation has come down from peak levels, so real earnings
for a couple months.
Positive.
They're still below where they were.
They are, but I think consumers are feeling the pinch. They're feeling the pinch of higher prices, higher borrowing costs. They're becoming more price sensitive, and we see this dramatic shifting of goods and services in their basket month to month. But again, the underlying momentum, consumers are still spending in the marketplace. And 2% growth in terms of expenditures, that's still indicative of a solid message for overall demand.